Today, we're talking about something that sounds technical, but actually tells us a lot about how Canadian households are really doing financially. Mortgage arrears. You may have seen headlines about rising arrears, but what does that actually mean? Is it a crisis? How worried should we be? And why do different sources seem to report different numbers? Let's break it down.
Financial stress around mortgage payments usually builds over time. At first, homeowners are on track, making their payments as scheduled. If financial pressure increases, someone might miss a payment. This is called a delinquency. Delinquencies happen in stages, 30, 60, 90 days late. These are considered early stage delinquencies. Once a mortgage reaches 90 days past due, we generally say it is in arrears. If payment problems continue, for example, 120 days late or more, the situation becomes more serious. At the most severe end is insolvency, when someone can no longer meet their financial obligations. Mortgage arrears sit between early warning signs and the worst case scenario, an important indicator of rising financial stress.
Mortgage arrears aren't just about missed payments, they're a signal of financial stress.
When a household reaches the point of mortgage arrears, it usually means they've already tried other coping strategies first. So, by the time mortgage payments are missed, it often means those safety nets are running out or gone. Arrears can affect someone's credit score, limit future borrowing options, or even transferring to another lender for renewal. And if the situation continues, it increases the risk of foreclosure.
One really important thing to understand, mortgage arrears are what economists call a lagging indicator.
So put simply, they tell us more about financial stress that has already been building rather than what's about to happen next. People don't usually miss their mortgage payment the first month something goes wrong financially. They prioritize mortgage payments above all else. They try to adjust spending, they dip into their savings, they'll rely on credit cards or lines of credit. So we'll often see stress show up first in things like credit cards or auto loans, for example, and only later in mortgage arrears. So when arrears rise, it's like looking in the rearview mirror. It confirms that pressure has been building up for some time.
If you've ever tried to look up mortgage arrears data, you've probably noticed something confusing. There isn't just one number. That's because Canada has several different data sets and they each capture different parts of the market.
Each data set gives us a different lens on household financial stress. That's why it's important to understand what each one actually covers. The CBA dataset includes data from 9 large Canadian chartered banks, including the 8 largest. That represents close to 80% of outstanding mortgage loans. It's widely cited and has a long history, which makes it very useful for tracking trends over time. But it doesn't include credit unions or many other non-bank lenders, so it doesn't capture the entire market. Equifax provides one of the broadest views of the market. It covers roughly 85 to 90% of mortgages, including banks, credit unions, and many non-bank lenders. CMHC often uses this data set in our residential mortgage industry report because it gives us a more complete national and regional picture. This data set focuses specifically on lenders outside the major banks, so it includes credit unions, mortgage finance companies, and alternative lenders. These lenders often serve borrowers with higher risk profiles, so arrear rates tend to be higher in the data set. That doesn't make it worse data, it just highlights part of the market that other data sets may miss.
So, which number is the right one?
There isn't a single perfect number. Each data set tells part of the story. If we only look at bank data, we might understate stress amongst higher risk borrowers. And if we only look at non-bank lenders' data, we might overstate overall market stress. By looking at all three together, we get a more accurate and balanced understanding of what's happening across the housing system.
There's another important piece of context when we talk about mortgage arrears in Canada: how our system compares internationally.
Canada has what are called recourse mortgages. That means if someone defaults on their mortgage, the lender could legally pursue other assets, not just the borrower's home, in order to recover debt. In many other countries, mortgage systems are non-recourse or have much weaker recourse. And so in those cases, borrowers can sometimes walk away from their mortgage by handing back the keys with fewer financial consequences. That difference matters. In Canada, recourse creates a strong incentive to prioritize mortgage payments, even when finances are tight. As a result, Canada has historically had very low mortgage arrears compared to other countries. When analysts look at mortgage arrears here, we need to consider three things: the current level compared to history, the trend, are they rising, are they falling, and the pace of change, how fast are they moving. That context helps avoid misinterpreting what the numbers are really telling us. Mortgage arrears are one of the clearest signals that we have of household financial stress. When they move, it tells us something important is happening beneath the surface.
Behind every data point is a household, a family, a real person.
Financial stress can take a real emotional toll. If someone is struggling with debt or finding it difficult to make ends meet, there are supports available, including nonprofit credit counselors and consumer protection resources like the Financial Consumer Agency of Canada.
Mortgage arrears are more than a statistic. They're a signal. They're a warning light. And they help us understand the real financial pressures facing Canadian households.